Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Okay, today we start our government intervention topics, and the first of these is indirect taxes. Government intervening in markets. Okay, quick explanation of what indirect tax is again.
An indirect tax is levied on goods or services rather than on an individual or a company. One example of an indirect tax is the sales tax customers pay for items they purchase for their personal use. The store collects an indirect tax from each customer in the form of an additional cost placed on the purchases. The state or county determines the amount of the sales tax, which is normally calculated as a percentage of the total purchase cost. The store eventually files a tax return and forwards the tax money it received from the customers to the government. With indirect taxes, the taxpayer can shift the burden of paying an indirect tax to someone else, unlike a direct tax. Federal income tax is an example of a direct tax. There is no intermediary between the taxpayer and the government. Indirect taxation tends to take a greater toll on people with less money. That's because the poor pay the same amount of tax as the wealthy.
And an example of an indirect tax is an excise tax as well.
An excise tax is an indirect levy charged for the sale or use of a particular item. The tax is indirect because the merchant or manufacturer must charge the tax to the purchaser and then remit the amount to the government. There are two types of excise taxes, ad valorem and specific. An ad valorem excise tax is charged based on a fixed percentage of the value of a good or service. Property taxes are the most common form of ad valorem tax. A specific excise tax is charged per unit sold. Taxes added to gasoline sales are an example of specific excise taxes. Excise taxes are sometimes used to tax goods and services society deems unnecessary or even harmful. The intent is to reduce the use of these goods and services and also compensate the government for the costs it incurs to deal with the harmful effects of products. Excise taxes are imposed on cigarettes, alcohol, gambling, truck highway usage, ammunition, and even tanning beds. Because of the nature of the things that are taxed, these types of excise taxes are often referred to as sin taxes. Also, excise tax is often used to describe the tax associated with the penalty for certain improper individual retirement account withdrawals. For instance, there is a 10% excise tax on most IRA withdrawals made before the participant reaches 59.5 years of age.
Okay, so an excise tax is an example of an indirect tax, and typically we're charged on goods and services that society deems harmful. Cigarettes and petrol and alcohol being prime examples. Value-added tax, another type of indirect tax, another type of specific indirect tax.
Value-added tax, or VAT, is a tax on the added value of a good as it moves through the supply chain to the end consumer. In effect, the tax is levied on the gross margin at each point in the manufacturing, distribution, sales process. VAT is primarily used in the European Union. VAT is assessed and collected at each stage of the supply chain, in contrast to sales tax that is assessed and paid by the final consumer at the very end of the supply chain. Dulce is an expensive candy manufactured and sold in the country of Alexia. Alexia has a 10% value-added tax. Dulce's manufacturer buys the raw materials for $2 plus a VAT of 20 cents, payable to Alexia, for a total price of $2.20. The manufacturer then sells Dulce to a retailer for $5 plus a VAT of 50 cents for a total of $5.50. However, the manufacturer renders only 30 cents to Alexia, which is the total VAT at this point, minus the prior VAT charged by the raw material supplier. Note, the 30 cents also equals 10% of the manufacturer's gross margin of $3. Finally, the retailer sells Dulce to consumers for $10 plus a VAT of $1 for a total of $11. The retailer renders 50 cents to Alexia, which is the total VAT at this point, $1 minus the prior 50-cent VAT charged by the manufacturer. The 50 cents also represents 10% of the retailer's gross margin on Dulce.
Okay, so VAT is primarily used in the EU. It's the EU sales tax or goods and services tax. An example of an indirect tax, which we're looking at right now. Now, we know from our supply topic that the government placing indirect tax on a good or a service will decrease the supply of that good or service. So here we have initial market equilibrium where supply meets demand, giving us an initial equilibrium price of $2 and the quantity bought and sold in this market, 80 million kgs in this stage. Okay, so government places an indirect tax on this particular good, and that decreases supply. Supply curve shifts left. Now, before the market can respond, there's a shortage at the price of $2. Quantity demanded is still 80 million kgs, but the quantity supplied now, $2, is just 20 million kg, resulting in a shortage in the market. And we know now that market forces will come into play. The shortage, consumers are going to bid up the price in order to obtain the good. So price rises to the price consumers pay, about $2.75 in this case, and quantity supplied increases as the price increases and quantity demanded decreases as the price increases, resulting in the new equilibrium quantity QT for Q tax here. Interestingly, producers take a hit with an indirect tax. They pay some of the indirect tax and consumers pay the rest. So PP is the price that producers receive for this good. PC is the price that consumers pay for this good. And the difference being the amount of tax per unit. So PP, the price producers receive, PC, the price consumers pay. The difference between the two is the amount of the tax. So we have a consumer surplus before the tax and a producer surplus before the tax. Government intervention in the market results in a smaller consumer surplus and a smaller producer surplus. Much of the lost consumer and producer surpluses is going to the government now, government tax revenue, which is calculated as the difference between PC and PP, the price consumers pay, the price producers receive, multiplied by the new quantity in the market. But the loss of producer surplus, the loss of consumer surplus, that's not going to the government, is deemed a welfare loss. This is a loss of allocative efficiency that is going to nobody. It's lost. A deadweight loss. So here's an essential statement for you. An indirect tax will increase a firm's cost of production. That's why the supply curve is shifting left. The producer's profit at each price decreases when an indirect tax is imposed on each unit of output, or that indirect tax is increased. So the producer reduces their supply of the good or service and the supply curve shifts left. Now, excise tax is a relatively efficient source of government revenue collected on each tax good or service that's produced and sold in the market. The more inelastic the demand for a good or service, the more government tax revenue will be generated. That's why excise tax is often applied to goods and services which are considered necessary. They have a low degree of substitutability. So indirect taxes, excise taxes on cigarettes, alcohol and petrol, necessities, produce a relatively large share of government tax revenue. So why do governments impose indirect tax? They're a source of government revenue. They will discourage the consumption of harmful goods. They're pushing up the price. And as a result, the quantity demanded decreases. So discouraging the consumption of goods and services that are considered harmful to the individual and society. So cigarettes, for example, inflict enormous harm on the consumer. Heart disease, cancers, premature death await the majority of smokers out there. But not just smokers, but those unfortunate enough to share their cars, offices, homes, restaurants, bars and cafes. Anyone smoking in these places is affecting, damaging the health of others. Taxing cigarettes reduces their consumption. Increasing the price reduces the quantity demanded. They can be used to redistribute income as well. So some governments may impose an excise tax on luxury items that only the wealthy can afford. And then the tax payments on that can be used to address income inequality, to boost the incomes of low-income earners, perhaps. So yachts, expensive cars, first-class plane fares, etc. After-tax incomes are reduced when the rich purchase these particular goods, and that closes the gap with those on lower incomes. Also, excise tax revenue can be used to boost low incomes through transfer payments and free or subsidised health and education. And indirect taxes can be used to improve resource allocation. And we're going to go into this in much more detail in the next little unit that we study. So cigarettes are underpriced and overconsumed in the free market. It's hard to envision, actually, a market where cigarettes don't have any taxes on them, because just about every country, certainly every developed country in the world, has these indirect taxes on these harmful, negative products. So cigarettes are underpriced and overconsumed in the free market. And without the intervention of an excise tax to reduce the supply of cigarettes and bump up the prices, more cigarettes are going to be consumed. More third parties would be affected, passive smoking, and there's going to be more undue strain on a nation's healthcare system. Smoking causes diseases. Diseases cost money to treat. In this case, the excise tax has been designed to improve allocative efficiency in the market. And in economics, we refer to this as correcting a negative externality, which again, we're going to go into in much more detail in another few weeks. A negative externality is a cost that's suffered by a third party, for example, a passive smoker, as a result of economic transaction, the consumption of cigarettes. In a transaction, the producer and consumer are the first and second parties. The third parties include any individual, organisation, property owner, etc. that may be affected by the production or consumption of a good. Two types of indirect taxes. The first is a specific tax, and this is a per unit tax. A tax that's defined as a fixed amount for each unit of a good or service sold, such as cents per kilogram. It is therefore proportional to a particular quantity of a product sold, regardless of its price. 1 million packets of cigarettes being sold in a market, and the excise tax perhaps being $5 per packet of cigarette. So a specific indirect tax is a fixed amount applied to each unit of output, causing the new supply curve to shift upward and parallel as supply decreases from S1 to S2 here. So an example would be a $5 excise tax being applied to a packet of cigarettes, and that's going to shift the supply curve up by $5. So the supply curve decreases in parallel to the initial supply curve. Whereas with an ad valorem tax, the charge levy is a percentage of the value of the item it's being imposed on, not the item's quantity, size or weight, or any other such factor. Like VAT and generally import duties are ad valorem taxes. And we see the supply curve growing further and further away from the initial supply curve when an ad valorem tax is imposed. And that's just the nature of a percentage. So the tax is calculated as a percentage of the price. Therefore, as the price of the good increases, so too does the amount of indirect tax being applied. So a 50% excise tax on cigarettes is going to increase the price of $1 packet of cigarettes to $1.50. And the excise tax on a $10 packet of cigarettes to $15. So it's the same percentage, but the greater the value of the product, the larger the tax take for that indirect tax. And that's why the supply curve does not shift in parallel. Right, the effects on stakeholders. Consumers are going to be worse off when an indirect tax is placed on a good or a service. They're consuming less of the good and they are paying more for it. And we've really seen that the consumer surplus will decrease when an indirect tax is placed on a good. And the loss of producer surplus occurs in a similar fashion. So producers are also worse off because the output of the good has decreased and they're receiving less revenue for each unit of output. So they're selling less in the market, and for each unit they're selling, they're receiving less than they had previously. Producer surplus decreases from PS1 to PST, PS tax. The government must be better off because it's generating tax revenues, and that's going to increase the government surplus or reduce the deficit, and it's going to enable the government to spend more on transfers and the services that a good government provides, such as education and health. It's going to enable the government to repay debts or save surpluses for added fiscal stimulus in an economic downturn or recession. The gain in government tax revenue is shown below. So again, the gain in government tax revenue is the difference between what consumers pay for the good in the market, what producers receive for the good in the market, and multiplied by the quantity that's bought and sold in the market after the tax is imposed. Workers may be worse off as firms reduce their output as a result of the indirect tax. It is likely that firms are going to require fewer workers to produce their product, less employers making less of the product. Employees who are made redundant have their employment contracts terminated. They become unemployed and will certainly be worse off. Society as a whole. Now, we're not specifically talking about demerit goods here, like where it is good to reduce the consumption of cigarettes, alcohol, polluting petrol products, etc. As there's now an under-allocation of resources on producing the good or service, remember, quantity one is decreasing to the new quantity with the tax in place. We're able to say that society as a whole is worse off. But for a demerit good, that good or service whose consumption is considered unhealthy, degrading, or otherwise socially undesirable due to the perceived negative effects on consumers themselves, it is overconsumed if left to market forces. And as we're going to see later, if the government believes that there's an over-allocation of resources to the production and consumption of the good, so a nasty cigarettes, then an indirect tax is an efficient intervention to correct for the market failure, and society will be better off. It'll be worth doing just for the reduction in the quantity produced and sold in the market. Calculating the effects of excise taxes is pretty easy. Just a standard calculation, really. So we can measure quantities and how that's affected, and we can measure prices and how that's affected for both the consumer and the price that producers receive. So if we want to calculate the consumer surplus before, then we just calculate the area of the triangle. In this case, it's the difference between where the demand curve intersects with the price and the initial equilibrium price. So in this case, it's $4 minus $2 multiplied by the quantity purchased in the market. That's quantity demanded, so 80. So $2 times 80, and then we find half of that, and the result is $80. In this case, 80 million actually. Producer surplus, similar thing. We're just working the area of that triangle below the initial equilibrium price and above the initial supply curve. And that doesn't change, right? Just our triangles get smaller. So the differences are for the consumer surplus, the difference is now $4 minus $2.75, and the quantity demanded in the market has dropped down to 50. So the consumer surplus here is $31.25. We can see that's a decrease. We can calculate the decrease. We can calculate the change. And a similar thing goes on there for the producer surplus as well. And just because in these examples the producer surplus and the consumer surplus are the same, that's just the way the supply and demand curves are positioned. They certainly are not necessarily going to be equal. We can calculate how much government revenue the tax brings in, and that's the difference between the price the consumers pay for the good, price producers receive for the good, and the new quantity purchased and sold in the market. And another triangle we can calculate is a dead weight loss, a loss of efficiency in the market. And again, it's just a calculation here, finding the area of the triangle. This is year 9, year 8, year 7 mathematics. Easy stuff.
Price elasticity of demand describes how changes in the cost of a product or service affect a company's revenue. For some products, a change in price will dramatically influence how many units the customer will buy. In other cases, price movements have little effect on demand. Therefore, understanding the price elasticity of each offering is crucial to maximizing profit. To calculate elasticity, divide the percentage change in quantity demanded by the percentage change in price. Usually the number will be negative, as price decreases generally induce shoppers to buy more of the product. A number between 0 and 1 indicates an inelastic good. In other words, the customer is relatively unaffected by the new price. Numbers above 1 indicate elastic demand, where shopping behavior changes significantly. Several factors can affect the price elasticity of products. For example, if substitute goods are readily available, the customer will immediately curtail purchases when the price rises. And if the good represents a major part of the buyer's total spending, he or she will be more likely to shop based on price. A new car fits into both of these categories and therefore represents elastic demand. If an automaker dramatically increases its pricing, the customer is likely to shop different makes or hold off on his or her purchase altogether. By contrast, public transportation consumers have few alternatives. Many train or bus riders don't have a car, so moderate changes to the fare will have relatively little impact on how often they ride. Understanding how consumers value a product can be vital for any company. Raising prices can be one of the easiest ways to boost profits, but only if consumers are willing to accept the added cost.
Okay, so just a quick recap there of price elasticity of demand. And we can relate that to our indirect taxes by talking about something called the tax incidence. Now, tax incidence or tax burden is where we analyse the effect of a particular indirect tax on the distribution of economic welfare. So tax incidence is said to fall upon the group that ultimately bears the burden of or ultimately has to pay the tax. Now, producers, in the case of indirect taxes, producers and consumers share the tax burden. So consumers pay more for the good and producers receive less for the good than they did before the tax was implemented. And what this has to do with price elasticity of demand, that measure of the relationship between a change in quantity demanded of a particular good and its change in its price. We know that the indirect tax is increasing the price. Price elasticity of demand is a term economics use in discussing price sensitivity. So the law of demand states that as the price of a good or service increases, then the quantity demanded decreases. And essentially, PED provides us with information as to how responsive changes in quantity demanded will be to these changes in price. So sometimes a small price rise is going to lead to a large decrease in quantity of goods and services demanded, perhaps because the market is really competitive and there are quite a few number of substitute products. For other goods and services, a large price increase may result in a proportionally smaller change in demand, quantity demanded, perhaps because a good is a necessity, such as petrol, and there are few or any substitutes, say a drug that's protected by a patent. So, elastic demand and indirect tax, initial equilibrium gives us P1, and quantity demanded and quantity supplied in the market. Indirect tax reduces supply, increases the price, reduces the quantity supplied and demanded. Indirect tax revenue is calculated, tax per unit times the quantity demanded in the market. And here we have inelastic demand. Supply decreases by just as much. The supply curve shifts by just as much. The price is bumped up by quite a lot more with inelastic demand. And the quantity in the market is reduced by quite a lot less. So for any given indirect tax, government tax revenues will be higher the lower the price elasticity of demand of the good or service being taxed. And if we have a look here, the only difference between these two diagrams is the slope of the demand curve. On the left-hand side, we have elastic demand, that relatively flat demand curve. And on the right-hand side, we have the inelastic demand, that relatively steep slope of the demand curve. Same tax is being applied, but in this case, the quantity demanded decreases by quite a lot less, and the government tax revenue is a lot higher. And let's just have a look at this in specific terms of the producer and consumer stakeholder groups in an economy, those that produce and consume the good. So we know that the indirect tax raises the price to consumers, so that's PC. They are now paying the difference above P1, that initial equilibrium price, and producers are receiving a lower price PP. So the consumer incidence and the producer incidence are clearly highlighted here in this diagram. And we can see that the price consumers are paying is relatively less than the hit that the producers are taking in terms of how much they're prepared to take on the chin. And that's the opposite for inelastic demand, where consumers bear the greatest incidence of the indirect tax and producers a relatively smaller share of that indirect tax that is going to government. So 2 essential statements here to make clear, along with your diagrams and your explanations. When demand is relatively price elastic, the producer incidence, shown here by the pink rectangle, will be greater than that of the consumer incidence, shown here with the yellow rectangle. So producers should shoulder relatively more of the tax burden than consumers do. And that's the opposite case with price inelastic demand, when demand is relatively price inelastic, the consumer incidence of the indirect tax is going to be greater than that of the producer incidence. We see here that the consumer incidence, indicated here by the yellow rectangle, is relatively high compared to the producer incidence, which is indicated with the pink rectangle here. This means that consumers are shouldering relatively more of the indirect tax burden than producers are. And we can have a similar analysis as well with price elasticity of supply and tax incidences in place. So just a quick recap, price elasticity of supply measures the responsiveness of the quantity supplied to changes in price. There's a positive relationship between price and quantity supplied, and that follows the law of supply. As price increases, quantity supplied increases, price decreases, quantity supplied decreases. And PES also provides useful information as how much of the quantity supplied of a good will change in response to a change in price. So just like with PED, with PES, for some goods, a small price change can result in a relatively large change in the quantity supplied of a good. This is elastic supply. For other goods, a relatively large price change will not change the quantity supplied by that much in elastic supply. And when we model this with our indirect tax, we can see that the same sort of pattern holds true. So when supply is relatively price inelastic, the producer incidence of the indirect tax is going to be greater than that of the consumer incidence. That means that producers are shouldering relatively more of that tax burden that has to be paid to government than consumers are doing. So this is when it's inelastic. So this is a change to price elasticity of demand. And on the other side, when supply is relatively price elastic, consumer incidence of that indirect tax is going to be greater. They're going to be paying a relatively greater share of the tax to government than producers will.